Okay, so this is the first test for these live webinars. Perhaps this isn't the best time to record them, but it's at least a first test. And I've gotten a question here in text form. Tesla shares are going up again. Are you planning on shorting it again? I don't have a plan to short Tesla. I don't really think there is a good reason for any private individual to have plans to short any stock. I myself try to stay away from shorting single stocks as much as I can. The only real exception to that rule has been Tesla this year, starting in January of 2025. The reason that I did short it then was that I thought the setup was really good. The stock price had been exploding upward, actually doubling from a very expensive level and then doubling after Trump's election win. And I thought once it had then formed a kind of a double top, I thought this is a good place to start shorting it. But I don't intend to make significant money from shorting. I'm rather always trying to bubble sort my investment prospects, bubble sort them according to risk-adjusted returns, and then I go long whatever offers me the best risk-adjusted return, and that is a combination of fundamentals and technicals, both technicals for the company itself or the asset class or the asset. I mean, it could be gold or silver. It could be gold or silver miners or uranium miners. All of these are some of my favorites. I'm also often looking at a couple of serial acquirers, some of higher quality, some of lower quality, or just ordinary investment companies like Berkshire Hathaway or Investor, Latour, etc. Anyway, so I'm not planning on shorting Tesla again, but if I were to anyway indicate a place where it might become interesting again, it would be after the next hype cycle. So I'm expecting Tesla to drum up a new hype top for the company. It has to do with launching a self-driving robotaxi in Austin, Texas, I think it was. Doesn't matter where it is, but they are launching finally after 10 years something that at least approaches a self-driving car. I don't think they have all the regulatory approvals in place yet, and I also think that the robotaxi will actually have to feature legally a driver. So it's not actually a robotaxi, but I think it can drum up some hype around the company, and analysts will start issuing ideas of how much this can be valued. And we have already seen Cathie Woods saying that the robotaxi business can be worth more than the entire US economy. So she used a $34 trillion valuation and thought that Tesla would be the dominant player in that market. So recall that Tesla is at about $1 trillion in market cap today. And she thinks that the robotaxi business can become worth about 34 times the total market cap of Tesla. So there is definitely room for drumming up some hype around this. And then on top of that, we have the Optimus robot that is in kind of a semi-launch mode, stealth launch mode. You can expect jaw-dropping videos of Optimus doing new things. For one, I'm expecting within a year that Tesla will showcase the Optimus copying exactly that silly dance that the guy in spandex did a couple of years back to start the robot revolution within Tesla. I don't expect these things to evolve into real businesses anytime soon. and I also rather see a lot of negative signals regarding the Cybertruck and the Semi. What I'm expecting and hoping is that the Optimus and the Robotaxi launch will cause a hype in the stock price, maybe taking it to $600, maybe $700 per share. Remember that the last peak was more or less the even number 500. So I am expecting a new all-time high for the stock, created by this unwarranted hype. And if I again see some kind of a double top up there, then possibly I would be tempted to short it again. But please note that when I short a single stock like Tesla, I use a certificate. It's a complex instrument with a lot of hidden costs in terms of spreads and the cost of borrowing and daily resets of the leverage. These are actually very stupid instruments to be playing in, and I only do it for some fun and some bragging rights. Sure, I did have a really good run, more or less a perfect record earlier this spring, but part of that was simply actually I wanted to show you that sometimes Tesla is so silly that you can use silly instruments and still make a lot of money. And also recall that I was only playing with about $1,000 at a time, although sometimes the position grew to $10,000. But around there, I started shaving off, reducing the position, usually pretty quickly down to $1,000 again. In the end, I made around $25,000 on my $1,000 in risk, but the final $1,000 expired worthless, more or less, a few weeks back, and since then I haven't touched it. I closed the position when Tesla went up through the 200-day moving average, more or less. So anyway, no, I don't have a plan on shorting Tesla again. Let's see what's more here. How realistic is the scenario where Tesla just stays at irrational valuation for the coming 10 years? Well, it has been at an irrationally high valuation for the last 10 years. So just invoking the Lindy effect, it could very well stay irrational for another 10 years. Remember that there is a potential, there is some off-chance probability that Tesla actually manages to sell millions or even billions of their Optimus robot. Maybe Tesla's AI business is superior to all the other players. That would of course be unprecedented in the history of business. But there is a small chance that they actually make this into a super profitable and huge business if they manage to get some kind of a lead. So things actually can happen that create a warranted high price for Tesla. And the longer they stay a big company and the longer they have enough cash to invest in these ventures, the higher the probability that they actually will manage to create something of high value. However, that is definitely not my scenario. My scenario is rather that all companies have their time in the sun, and then competition catches them. That is what we're seeing now with Tesla's car business. The car business is about 85 to 90% of their sales, but the valuation of Tesla is to at least 90% the other stuff, and the other stuff isn't really profitable, and is a very small part of the business. So the other stuff is like 100x overvalued if you assume that their car business is more or less fairly valued. So Tesla is a very odd company and an even odder other stock, and shorting a company like that and a stock like that is extremely difficult and dangerous, because there are no like rational factors to hold on to. And I was going to compare it to companies like Wirecard, this fraudulent payment system in Europe that was the poster child of European innovation and in the fintech space, and then it turned out to be just a fraud, more or less a Ponzi scheme. And talking of Ponzi schemes, we have this the old Madoff scandal, where he got to run his hedge fund for 30 years without authorities putting an end to that Ponzi scheme, or even though there were whistleblowers 10, 15, almost actually 20 years before the scandal actually broke and bankrupted the Madoff's hedge fund. So these things happen all the time, that you can keep a kind of a fraud going for decades before. Well, just recall Enron. Enron and Tesla are actually pretty similar businesses. There is a kernel of truth, a kernel of value creation, but this hype cycle comes along and is exploited by management, and then it gets a life of its own, and you never know how many years or even decades it will last. So I would actually expect and suspect that Tesla will be irrationally highly valued for many years to come. That, however, does not exclude it from being shorted from time to time if the setup, especially the technical setup, looks good enough. All right, enough about Tesla. So let's move on to question number 2 here in the chat. There's a question about psychology of investing, the best practices in my experience. Well, unfortunately, we don't really have a live audience here, so it's kind of difficult to know exactly what you're asking about. Best practices in my experience. Well, I have one general best practice, and that is you should never hit the buy or sell button when you are emotional. If you're feeling rushed, if you feel a fear of missing out or an urgency, or if you actually generally feel fear, or that any emotion or feeling is wrong to base your investments on. If you feel like you have your hand hovering above the execution button, and you have this rush of thoughts just streaming in your mind's eye, and you're thinking like, oh, if I buy it, then maybe I make a lot of money, but if I don't, then I might lose money, and what if and these things just like, should I buy, should I sell, should I buy, should I sell? What the best practices is at that point is just get up, walk outside, walk around the block, just take deep breaths, watch trees, watch nature. Once you have calmed down and you hopefully come to a logical and calm conclusion when you're outside, you decide what you want to do and why, and you think through the consequences calmly, methodically. Then you simply get back up to your computer, execute. No emotion, no feeling, just do what's right. Another thing to consider might be, or is, to behave as if you are managing your best friend's account, or your father's account, or your brother's account, or maybe that you're running a public fund that will be scrutinized for the quality of its decisions, as well as the overall outcome. If you imagine managing somebody else's money, somebody that you care about, then that typically makes you keep control of your risk. You keep the risk within the preset levels that you think are simply where you want the range of risks to be. So that's a second very practical way of thinking about investing and controlling risk, and also keeping emotions out of the picture. That's a second one. I did have a third one in mind. If you find your positions being so large that you constantly feel emotional and fearful or greedy, then you should reduce those. One way to think about them is that, what if the position suddenly takes a 10%, 25% or 50% air gap downward? How would that feel? So you, rather than acting on feelings today, which you never should, you could time travel into the future and consider those feelings. And you could actually logically, methodically trade on those today without being emotional today, because you know that if you have a position that, were it to crash in the future, you know that you would feel immense amounts of negative emotions, probably causing you to make all kinds of irrational decisions. Then you should halve the position today, or just get rid of it altogether. If it's a good position but simply too large, reduce it today. You should never hope that something goes right. That is, well, if you are really poor, then you might buy a lottery ticket. You might take a chance with your life. You might do something really stupid just in order to survive. But if you already have an okay life, you are above the minimum poverty line, then there is no reason to just aim higher by taking stupid chances. I mean, you would never buy 1 million lottery tickets because you know you will lose money. You might buy one. That might be okay. Of course, you can have fun as well in your investing. But in general, if you have enough money, then you don't need to speculate on shit coins or shit companies or biotech binary outcomes of a clinical trial, and especially not with significant amounts of money, a significant portion of your total investment portfolio. So in general, if you feel that the position you have is pretty big and you're basically just hoping for the upside and dreading the downside, then you should reduce it already, as if you expected the negative outcome. So again, just don't stick to unnecessarily large positions that would crush you financially and or psychologically, were they to go down significantly. So those are the three, I would say, main best practices for controlling your psychology when investing. I've written a book called The Art of Sprezzatura, which consists of 12 rules for controlling your temper and your investor traits. I've also made a poster of it. So there's the book and the poster which goes through these in detail. And they in turn are made from 50 rules of execution, or 50 lessons that I learned myself on the job during my first 15 years as a hedge fund manager. So I went through our 60 plus most important decisions over 15 years, distilled those into 50 lessons, which in turn were made into 12 investor traits or psychological traits that are really good to have, both in life and as an investor. We could come back to them at some future video or simply as a lecture series part, just taking one rule at a time. All right, yeah. All right. Enough of psychology. So, next question. When the market is priced for perfection, what signals tells you that it might be time to reduce exposure? Is it technicals, macro data, valuation metrics, or something else? That's just simply too difficult question to answer. You can never know. How would I even know that the market is priced for perfection? Especially the market. But maybe when we talk about a single stock like Tesla, just look at the history of the share price. There is no way to tell that they are priced for perfection and that it's time to reduce exposure. You can't time it. The examples of many single stock bubbles just show that you can be off by several 100%. So you really can't tell. And I advocate just keep updating your list of your 5 or 10 or 20 best ideas, maybe 50 ideas if you're really ambitious and have a lot of time and resources to spend on investing. Just keep updating that list and make sure that you never stick too long to a position that is exploding upward in valuation. Of course, there is some logic to just hold on to the winners and outsource in a way the valuation and the assessment of the company's quality and future to other investors. But there's a danger in that as well. I mean, riding a bubble is always dangerous, and you shouldn't, I think, let your largest position become overly large. Very rarely should your top position be more than a third of your total portfolio. Very, very rarely. Usually I would advocate most investors to keep about 10 positions of around 10% each. And whenever one position gets out of hand, let's say it increases to 20% if you have 10 positions, then you should really go into depth with the valuation and the logic and arguments for keeping it. If it's expensive, it's expensive, and you're probably in a situation like that when something suddenly doubles in share in proportion of your portfolio, then you probably have some other stock that deserves increasing at the cost of decreasing that position that just suddenly grew out of hand. But it all depends on, one, the valuation of the company. Just look at the multiples. Are they warranted? And two, what does the technicals look like? Typically, the technicals would look really, really good for a company like that, at least in a trend and 200-day moving average point of view, but probably also would look a bit negative from a Bollinger Band point of view. But my main comment or answer here is just keep an eye on your total portfolio and the individual weights, and make sure that no position just gets out of hand, and especially not if its valuation metrics are at the very high end of the range. Can mega cap tech still deliver strong returns over the next decade? Yes, they definitely can. Whenever I go through the let's call it the Magnificent Seven or the Batman companies, the Mana companies, I'm typically struck by how inexpensive they are. Sure, Tesla is a unique case. Amazon is sometimes a little bit difficult to stomach, but it's not super expensive. I usually come to the conclusion that Meta is cheap, Alphabet is cheap, Microsoft is a bit overvalued, Apple is probably quite a lot overvalued. So I'm actually thinking about perhaps rebranding myself into Apple short seller rather than a Tesla short seller, which I seem to have shouldered. But apart from Apple and a little bit Microsoft maybe and Tesla, many of these large companies definitely have room to grow. Absolutely delivering strong returns is a possibility. However, I would typically want to see more attractive valuations before going all in on these stocks. But for example, I mean, we've gone through these deep dives, for example, with Meta platforms, and Meta is one of the strongest AI companies, and they have enormous amounts of data from their 3 to 4 billion active users. Monetizing those users and expanding the areas into where Meta is making money, that should enable them to keep growing profits by 20-25% per year, and keeping probably their current valuation multiple all through, and that would mean that they would double their share price every 3 to 4 years. That is definitely plausible and absolutely not unlikely. And the same goes for Alphabet, for example, and to a little less extent some of the others. But there's definitely room for the mega caps to keep delivering strong returns for 10 years. All right, where do you think growth will come from in companies like Apple, Microsoft, or Google? Will it be AI, new products, international expansion, or operational efficiency? Well, I think they are as international as they can be. They are more or less as operational efficient as they can be. That they will keep churning upward. I would use Oracle as a great example of how you can increase over time your profit margins, just gradually every year a little higher margin because of their economies of scale. But I wouldn't say that's where it typically comes from. I mean, if they grow sales by 15% and then they grow their margins just a little bit, then maybe they can grow their EPS by 16 or 17%. They can increase that by another couple of percentage points by share buybacks, by using leverage in a smart fashion. But typically, I would rather call it's using AI and new products. But saying that, I think, gets us to this whole debate about what is technology. I mean, is Meta a technology company? Is Microsoft a technology company? When Microsoft is delivering boring administrative software, you could just as well have delivered clay tablets to draw on. Is that technology? Well, it used to be technology. Clay tablets and a stylus, that used to be technology. But who's to say that? I mean, Tesla, let's not take Tesla, take Volvo, for example. Building a car, that is tech. That is super heavy tech. It's just that they don't sell the car to other companies, business to business wise, to be used in another product. And that is what we typically think about when we think about technology. It's making a platform or a component that is used in other consumer-facing products. Intel or Nvidia or TSMC are hallmark examples of this. They create chips or design chips or manufacture chips, or as ASML delivers the tech that is used to etch the transistors onto the chip, and then that chip is used in Optimus robots or in computers or anywhere else. I don't really see the distinction here between technology and not technology. Apart from maybe if you're a hairdresser, then you're not a technology company. Anyway, so what I do see is companies like Meta selling more stuff to the same clients. So they expand their wallet share, so to speak, with their clients. And we have seen telecom companies do this for a long time. I mean, first they just delivered phone calls, and then they took they charged you for text messages, for multimedia services messages, and now it's just the general data traffic in total that they charge you for. Cable companies can add gaming and video and live sports streaming, etc. And this is where I see these huge mega caps going. Like Meta, they will sell headsets and glasses, and probably a whole swathe of other tools. Think about this: Ready Player One book, and then later a movie, where you will use full immersion VR suits to go into cyberspace, to sell all these peripheral equipment from running treks to these suits with haptic feedback. That's probably where Meta is going, and Apple is going there as well. And they will use AI tools to develop these. They will use AI to run them, to enable real-time data collection and feedback into the suits. They will use AI to train them beforehand to create the best experience. So in general, just making sure they take more and more of their clients' money and making sure everybody else gets less and less of that piece of the pie. This also in turn means there is, of course, a limit to how much a company can be valued in relation to the total economy. Because at the end we have consumers have income, or we have investors that also have income from owning the companies, and then they use that to buy the products. And this is a circular system where the money is just churning around, the value is churning, and the total value of all the companies cannot be higher than the total value of the economy, because they really are the same thing. But there is a balance between how much consumers and investors. So the classical dichotomy of capital versus labor, and as of now we've seen capital taking a larger and larger share of the total economic pie. That is what we're seeing in the valuation multiples of Schiller and Hussman. And so it can't go on. The valuation multiples can't go on forever, because that's simply just a high valuation multiple. It simply means a lower return on equity, or lower return to the investor, unless the underlying economy is speeding up. So everything is growing at a faster pace. Then you can keep the relative shares similar and still create a higher return. And you can actually even start from a high valuation multiple point, like it is today, with 3 to 4 times higher valuation multiples in terms of price sales than there has been historically. Okay, let's move on in terms of valuation multiples. Would you be comfortable holding a mega cap stock at a 25 to 30 times PE for 10 years? What conditions would need to hold true to justify that multiple long term? Okay, we were a little bit through that, but to be more precise, if I buy a company that or if I buy the index, and the index is valued as it has been historically, and I buy it at 15 times earnings, and the underlying profits keep growing by 8% per year, as they have done for listed companies in the US over 100 years, and it stays at a 15 times 15 times price earnings valuation, then I, as an investor, I will get a compound annual return of 10%, including dividends of 2%. So this has been the setup for the stock market in the US and also in Sweden, more or less, for the last 100 years. So what does it take to warrant a 25 to 30 times PE for something? Well, you would need to catch up or catch down, if you will, in terms of price earnings ratios. So let's say that your mega cap stock grows by 15 percentage points faster per year for 5 years. That is a relative doubling in earnings per share relative to the average, the economic average. That would mean that after 5 years, your 32x valuation would have come down to a 16 times valuation, and then from there on you would be on par with the average market. So if you can reasonably expect a 15% per year, percentage points per year outperformance in EPS growth, then after 4 or 5 years you would have caught up, and from that point on the valuation is the same for both the market and this company, but you would probably still enjoy higher than average growth, maybe not as high, but at least higher than average growth from there. What you have lost is 5 years. What you have gained is that after that 5-year period, you have something that is valued exactly as the market, but is still growing faster. And this is a long-winded way to simply say that if something grows by 5, 10, 15% more per year than the average company on the market, then it takes a certain number of years, 5, 10, 15 years, to catch up in valuation-wise. So what the conditions I would need to hold true to justify that multiple is that from any point in time, you would need to look out into the future on superior growth for earnings per share, or actually for cash flows, for a number of years. 5 years is enough if you're growing really quickly, let's say 15 percentage points more per year. But otherwise, if you're just growing by 5% faster per year, then you might need to expect it to grow by that much faster for 15 years in order to catch up. And that last example would probably not hold water, because there's no way you could expect a small outperformance for a long period and then also expect to be patient enough to wait for those 15 years for the on par valuation. So the conditions you would need to hold true is at least stable margins, probably increasing margins, quite a bit higher annual growth. All right, is it harder or easier for a 2 to 3 trillion company to double in value compared to a mid-cap? How do you think size affects opportunity? I would definitely say it's harder. There simply isn't room in the economy for another $2 to $3 trillion in market cap unless you take that from somebody. Historically, it's been very, very difficult for the top 5 companies to expand their market cap before first crashing down and then maybe catching back up and readjusting the top 5 or top 10 companies in the market. So it's definitely harder. However, we also have the aspect of capex budget. How much can a super huge company invest in future technologies? So we have seen that the top 7 companies, they are also now the leaders in artificial intelligence, simply owing to the fact that they are the only ones able to spend tens of billions of dollars on the fastest NVIDIA designed chips and create these training grounds for the next generation of AI. So this happens again and again in successive cycles of innovation. And we've actually seen this movie before, when Intel was absolutely unassailable as the #1 chip producing company around year 2000. So they were building on legacy of several decades of using whatever gains they had as a big tech company to invest in the next generation of a fab or a chip fabrication factory. And then leveraging on whatever profit that made, including the better equipment that was enabled by using the chips that Intel themselves produced. Then Intel used better equipment and their own money to buy that equipment and build the next generation factory, and just kept this going cycle after cycle until NVIDIA and TSMC found a way to leapfrog Intel in a way that nobody thought possible around the year 2000. So what you can say about that is that Intel was a large company that people thought would become ever larger, actually faster. And it seemed as if they were on track for that, until suddenly TSMC just leapfrogged them to make a long story short, by offering contract manufacturing, thereby enabling a larger scale than Intel. And once the scale effects kicked in, then they could innovate even faster than Intel, reducing costs and making better quality chips. And the rest is history, and Intel is more or less a bankrupt company these days, despite just 20 years ago or 25 years ago being considered absolutely dominant. And there was no way, I mean, if you even breathed some negativity about Intel, then you would be ridiculed and laughed out of the room. And I think this is probably true for some of the mega caps today too. It seems as if they have access to these huge budgets. They have enormous cash flow in from business customers, as well as now in a budding way from individual private single individual clients that want to pay hundreds or even thousands of dollars for their let's put this on silence. For using AI tools for their own amusement and sometimes for building businesses. But some of these companies will turn out to not be able to handle this huge amount of cash flows that they have. They will do malinvestments. They will invest in the wrong things, like the market thought that Meta was doing 2.5 years ago when they said they were going to focus on the metaverse. And that turned out to be more or less a mistake of the markets rather than of Meta's. And we have yet to see 10 years hence where Meta is going in terms of the metaverse. I mean, they are still called Meta, not Facebook. So the question again, is it harder or easier for a large company to double in value? Oh, it's much harder for a large company. It's definitely much harder. But they do have the potential, since they do have the money to invest. But it's still very difficult to invest that money in the right direction. On the other hand, they can also use the money to buy the mid-cap stocks, to do takeovers of mid-cap stocks, thereby actually making the mid-cap just double suddenly overnight in value. In any way, I would summarize that as no. It's mid-caps that have the potential to double and triple and 10x in value, not the top 5 $2 to $3 trillion companies. They have a very tall order in terms of trying to find ways of attracting more wallet share and client money in order to actually warrant their high price tags. All right, maybe the final question here, we'll see. What risks do you see for mega caps over the next decade? and that is in terms of regulation, competition, saturation, geopolitical factors, or changing consumer behavior and similar. Historically, it's been a truism in the market that a consumer electronics company can only hold their position for around 15, maybe 20 years before somebody catches them and invents something better. There used to be a time when IBM was absolutely dominant in the computer space and thought they were thought never going to lose that position. We had the situation in the 60s with the so-called nifty 50s, the 50 top companies that were considered so good that there was no price that was too high to pay for them, because they would always grow into the valuation. Those included Kodak, for example, and a lot of companies that I don't even recall the names of, because Xerox, Kodak and Xerox, for example. Where are they now? And Canon, I think, also was one of these companies, and they disappeared because to start with, no company has a moat that cannot be crossed. You have to keep investing in this defense system, in your patents, in client awareness, in your brand, and investing in your moats. That takes a lot of money, and that also leaves avenues for competition to catch up with you, because they don't need to invest in a moat in the same way. So they can be much more agile and trying different stuff. And there are thousands of companies trying different stuff, and sometimes one of them succeeds, as we have seen with, for example, Moderna, that created the vaccine for COVID, and suddenly exploded upwards 100x in valuation. And we've seen it in Amazon, that threw Barnes & Noble out of business. You probably don't even know Barnes & Noble, but it was the dominant book chain with huge offices. They used to own this Barnes & Noble skyscraper, like a super monument of their success in the middle of Manhattan. And then this little electronic bookstore came along and just caught up with them and made their name go out of business. So what's happening here, and what I'm trying to say, is that no matter how large you are, innovation can always come from the side and catch you. Oftentimes, the large companies will be able to buy up competition, as long as the Federal Trade Commission authorities allow them to keep buying up the competition. But right now we see this with Meta and Instagram and YouTube, that there is a court case going on that we will see what is actually is acceptable and not in terms of buying innovation. I don't think regulatory hurdles will actually break the hegemony of these large companies. But what I do see is that every now and then there is a DeepSeek moment, or as with the Facebook itself, when Facebook took over from MySpace, which was also supposed to be an unassailable dominant player in social platforms, and then Microsoft came along with a like button and just crushed competition. And this happens again and again. Look at Spotify. I mean, what was that 25 years ago? It was a pirate download music, like just a small startup. Nobody thought that they could claw their way into the music business, and now they are the dominant player. So I don't see regulation as that tough a nut for the mega caps. Competition, well, they are all competing with each other for wallet share amongst each other. But I think what that really does is opening up for even much smaller players to suddenly, in a way we can't really imagine, leapfrog these companies. Maybe somebody creates a consciousness generator, or finds by chance a biologically inspired algorithm that is many orders of magnitude better than what the others have. Imagine that a new company built by some of the 3 billion Chinese and Indian people now having access to all knowledge known by man, as well as super competent AI agents. Imagine one of these 3 billion people experimenting with just totally novel ways of handling self-driving, actually coming up with a driving algorithm that is that mimics the human brain and is demonstrably as good or better, or even just simply generally is a better AGI, and artificial general intelligence. If that were to happen, that company could immediately become worth $10 trillion and reduce the value of many of the others by let's say by half each. All right, let's see. Stuart is asking to speak, I guess. Okay, Stuart, you can only type your question in the message box. If you can't see the message box, you should have some kind of an icon to the far right and low to the low far right. You have a chat with everyone symbol, because we don't have the mics on for callers in. So okay, good. So I'm just waiting for your question, and I'll see if I can maybe finish off my answer meanwhile. So we're talking about geopolitical factors, changing consumer behavior, and similar. Yeah. So I think the two biggest obstacles for these companies are for the mega caps are competition from just completely new companies with novel approaches, and second is consumer behavior. We don't know what consumers will want. Probably they will want something that has to do with the Maslow hierarchy of needs. So and some of the things that we want, apart from a place to live, something to eat, enough sleep, we want companionship, and we want to be social in general, and we also want appreciation, that people see us and confirm us as individuals. This probably all means that I think Meta with their metaverse they are onto something. We will want to go into a second life and reinvent ourselves as avatars. But I also think that we will definitely want to spend more time in actual social events and with actual real people. So we will probably want even more of that unless we go completely insane. All right, let's see. Rig. Looking at Rig, so Rig is that not that old Transocean, the Norwegian Transocean company that make these the largest deep sea rig, oil rigs? Is that the one? Because at least it used to be a fully Norwegian company. So is Rig Rig the actual ticker name? All right. So what's your question regarding Rig? I must say that if it is Transocean, then I don't have an updated view of the company since I haven't covered it for some time. I'll see if I can. Just see if we're talking about the same company. So I'll just put in RIG in. Yeah, it says Transocean Limited here. It's actually it's listed in New York right now, and I don't see the Norwegian one, so probably they were taken over in a way or just relisted. Yeah, it's actually, yeah, you're right. It's now provides offshore contract drilling services for oil and gas wells in Switzerland and internationally. Right now, nowadays it doesn't say anything. Transocean was founded in 1926 and it's based in Steinhausen, Switzerland. It seems that if there is something has changed here. Maybe they were always a Swiss company, but they were listed in Norway. Because I'm used to covering and investing in Transocean as a Norwegian company. The Transocean that I remember, they were doing deep sea water rigs. Yeah, it says here ultra deep water floaters and harsh environment floaters. So it's definitely the same company as it used to be. It has a market cap of just 2.2 billion. So it's a very, very small company. The problem with the rig has always been this one that they have used when they are cash flow producing, they produce enormous amounts of cash flow, because when they're profitable, they are profitable, and when people want these deep sea water rigs, they definitely they want that and nothing else, and that is what's absolutely needed. And you can't just suddenly construct them. It's almost like constructing a mine to build one of these behemoths. Just looking at the share price, it peaked at 163 or something like that, let's say 160 in 2008, and now it's down at 2.50. So that's it's down by 98%, something like that, and it's almost at all-time lows. It's been down at below 1. A few years ago during COVID, when we had that absolutely total collapse of oil prices, and we have a collapse of oil prices the last year or so, and the share price has gone down from 9 to 2.50. So I can understand that you think it kind of looks cheap. The question is, from what point of view does it actually look cheap? So I'll actually bring up Koifin, and I'll see if I can share that screen in any way. Yeah, should be able to do it like that. And we'll bring up rig here live and see what it says. My guess is that they have a lot of debt. Because they have been going through a period with less income, but we'll see. That's just a guess. As I said, I haven't looked at their numbers for several years. And let's look at enterprise value. Well, yeah, they have been reducing their debt since that. You see the crash upward in debt here from 7 billion to 10 billion, and then they've used the cash flows, the subsequent cash flows, to pay it down. But they're still at 7 billion in debt. You can see here the debt, the absolute last number is 6.6 billion, but the market cap is just 2 billion. So their enterprise value is 8.6 billion. So what do they have that supports these $8.6 billion in value? Well, if we look at sales, we can look at EV to sales, and yeah, it's down to a level that we rarely see for Transocean. But what about EV to EBITDA? Is that as cheap? Well, yeah, in a way it is. 7 times EBITDA. That's definitely not expensive if we can expect them to be profitable and probably to also start growing again. And do we have any reason to believe that they have their profits under control? Well, here is their their net income for the last 6-7 years. Huge losses here, but that was only to be expected. But then they haven't been able to produce any profits at all since then. Again, looking at earnings, it might be misleading because maybe they have very high write-offs or depreciation, just normal depreciation, and they are holding off on their investments. So maybe their cash flows are better. So let's take a look at cash flows just to see if there's anything that looks positive here. Net income is negative, depreciation looks normal. You can see it's about the same level of depreciation all along. Please note that the y-axis is cut off here at 700, so this is a little bit misleading. It's just actually falling from 1 billion to 700 million. Depreciation is normal. There's nothing wrong here. Asset write-down. Okay, so they have been at least 1 year with a big write-down. Nothing else here looking suspicious, I would say. Let's look at cash from operations. All right, so they are at about 500 million in cash from operations. It looks pretty stable. So 500 million in cash from operations to support an 8.5 billion valuation. So that's an EV to cash flow of 17 times. That would at least demand or require some kind of growth or improvement, and we definitely don't want to see low numbers like 165 coming back, and at 450 that's mean it's 10% less than 500, which would mean that we're at about 20 times in valuation. Let's look at capex. There are only investing at about $250 million per year. So, in relation to their cash from operations, it's not too much, and it's also quite a bit lower than their depreciation. Remember, the depreciation was over 700 million. So if they only depreciate assets by 700 million due to high investments long time back in the history, and they invest 250 million, then that's a net cash positive of 500 million per year, just because they are in a bit of a runoff. The question then again is that sustainable? It seems as if this company is just it's content with just holding on to the whatever rigs they have, not build any new ones, just maintain the ones they have and hope for better oil prices. This can actually be a pretty good strategy because they are more or less alone in the world with these deep sea water rigs. But what's needed to increase demand and the daily rates paid for these rigs, what's needed is higher oil prices, because it's really expensive to use these rigs and rent them for drilling for oil. So you would need a deficit in the oil business in order for this to be profitable. You can see here also they have been issuing debts, but also paying back. Okay, so they just revolving their debts, so not much interesting happening there. Just make note that their cash from operations is turned into a very small free cash flow in the end. After all is said and done, they have for quite a few years now just been oscillating between a few hundred million plus or minus, and a total of zero for many years. So what we're looking at here is a highly leveraged play on oil prices, and that means that it is a good value if oil prices improve considerably enough for them to start making good cash flows and profits. Until then, if things just stay more or less the way they are now, then Transocean is slowly bleeding towards zero, actually. There's no way they can just suddenly reduce their costs more than they already have. And at $60-70 per barrel oil price, this is a losing stock, and I can definitely understand why the stock price keeps going down. And it's not actually even cheap on EV to sales or EV to EBITDA or price cash. Well, the market cap to cash flow is at least, well, we could at least say it's not very expensive, but it's definitely not cheap, and especially not considering that we are facing risks that we have no control over whatsoever. That is the global market price for oil and the demand for especially deep sea water rigs. I mean, there is also a political risk. You could see the world suddenly saying you're not allowed to go deep sea water rig drilling because it's dangerous for the environment. So they have a political risk as well. So all right. So I can't, with a good conscience, say that rig is a good investment at this point. It's highly leveraged. It's the risk is tied to the oil price. We're probably facing a recession, and the falling oil prices it rhymes with Trump's strategy for lower oil prices and a lower US dollar as well. No, unfortunately, I can't really say that Transocean is a good value play here. All right, I think that was it for today. Thank you, Stuart, for joining, and we'll see if we can find a better time of day for future Q&As to see if we can attract more of an audience. All right, thank you for today. Bye.